Money creation is never neutral. It disproportionately benefits the first recipients of money, governments, and it hugely negatively impacts the last recipients of money, savers in deposits and real wages. So what is going on these days in an environment in which they say that inflation is coming down is the destruction of the middle class. That is what's happening right now. We are living the destruction of the middle class through monetary and fiscal policy. Governments are raising taxes, and on the other hand, inflation remains elevated. And inflation is accumulative. When they say that prices are coming down because inflation has gone from 9 to 5%, that is not going down. That is reducing the percentage of increase in prices. And because it's cumulative, you have to add to where it's coming from. So if you had 5% inflation on 1 year and 5% inflation on the other, is going to be more than 10% in 2 years. So this idea that what we are living right now is a reduction in inflation is simply incorrect. What we're living is actually the destruction of the middle class via higher taxes and higher levels of, and more persistent levels of annual inflation. Remember, if I gain £10 in a year and I gain another 5 in the next, I am not getting any thinner. And that is exactly how inflation works. If inflation was 5% in 1 year, and it's 5 or 6% the other, it is rising much faster than it should, than it could, and it certainly is destroying the ability of the middle class to save and to purchase the daily goods and services. The big theme for 2023 is central bank losses. Central banks are losing records amount of money. Why? Because their bond portfolios purchased at negative yields are, negative real or nominal yields, are delivering monster losses for 2022. If you think of the record losses published by the Swiss National Bank, and that is one of the good central banks, that is one of the central banks that has not entered into crazy quantitative easing policies, massive monetization of debt at any price, etc. If you think of that, think about what is going to happen at the ECB. Think about what is going to happen at the Fed, but particularly at the ECB. Why? Because the ECB has been purchasing up to 100% of net issuances of most sovereign borrowers, including Spain or Italy. So the problem is double. On the one hand, the central bank is entering into big losses. On the other hand, these governments have not changed their fiscal policy and continue to incur into elevated deficits. So this is going to be a big challenge. What does the central bank do? If the central bank loses money, who pays? You, the taxpayer. So be very aware of that, because after the beautiful mirage of massive quantitative easing at any price and any cost, what comes is big losses and big tax increases. This is something that is likely to be a huge problem, because it can only change back if central banks start using sound monetary policy, and that is not likely to happen. The biggest risk for 2023 and 2024 are central bank digital currencies. Central bank digital currencies are surveillance disguised as money. The risk of getting into much deeper problems of monetary policy by giving central banks all of the information of what citizens pay and save, and at the same time destroying the transmission mechanism of monetary policy and making it one way, central bank directly to citizens, the inflationary risk is higher. That is why central bank digital currencies are not a good idea. It's not a good idea when the independence of a central bank has already been put into question to issue something that can lead to perverse incentives of destroying the purchasing power of the currency and increasing inflation for longer. So that certainly is something that we need to monitor. According to the latest estimates of Goldman Sachs, the Eurozone may escape recession in 2023. It has increased the outlook to growth of 0.6% in 2023 compared to a recession, a negative growth of 0.1% in the previous estimate. What is the driver? Fundamentally, the reopening of China and lower commodity prices helping reduce the burden of energy prices within the Eurozone. However, we must take into account these estimates because they're also saying a few things. There are a number of things that make it less rosy than what it looks. First, it all depends, again, on energy prices. However, citizens in the Eurozone are not going to see lower energy prices because of the change in commodities. Why? Because the increase in taxes and the increase in the CO2 price that is added, which is a hidden tax in itself, all of those things make the tariff that consumers pay elevated and rising even in 2023, certainly for electricity, very probably for natural gas, and it's likely to do a lot in terms of real disposable income. Why? Because in the Eurozone, real wage growth is hugely negative. Whilst in the United States, real wage growth is negative because the increase in wage growth does not offset the rise in inflation. In the euro area, that is already a big problem. So we have to take into account a few things. There is a GDP effect of very high government spending. There is certainly a GDP effect of the of the EU next generation funds that are going to be added to GDP, but don't generate a subsequent increase in GDP afterwards. And certainly the impact of energy. All of those things matter. However, what is the real problem of the euro area? The big problem of the euro area is that it was already in stagnation prior to the COVID-19 crisis. The German economy was close to zero growth in the fourth quarter of 2019. The French, Italian economies were already close to recession as well. So the real problem of these new estimates is that they are the confirmation of stagflation, elevated inflation, and low growth. Bonds are going up, equities are going up, and January is set to be one of the best months in decades for equities and bonds at the same time. Shows three things. First, equities and bonds continue to be heavily correlated. Not a good thing, because it shows that it is a monetary factor again. This is led by an improvement in the global liquidity conditions. And therefore, it's not just fundamentals. It's not just improvement in the perception of earnings, in the perception of the ability of issuers to repay their debts. This is a monetary factor. And being a monetary factor, the risk of elevated inflation for longer is also very high. Another relevant factor about the recovery is earnings. And in earnings, we need to pay attention to the problem of guidance. What are companies going to say to their investors about the future? It is not going to be so much about the earnings published, because we are seeing already the downgrades, and once those downgrades are embedded in estimates, then companies publish, and they always sort of, quote unquote, beat, the fake beats. No, you downgrade first, and then you say that the earnings were better than expected. So earnings are going to be something that is important, but not the driver. What matters is guidance. What are companies really seeing? Are companies investing more? Are companies seeing an environment of better margins? That is what we need to monitor in this part of particularly in the end year results and the first quarter results. More importantly, the ability to repay debt. We have to look at cash positions. We have to look at the ability to repay the maturities in a year of rising maturities all over the world. So, when we think about the market right now, it seems that it is giving us, in January, a great opportunity to reduce exposure to the more cyclical part of the landscape, to the more cyclical part of the asset base. That is what we need to think of going into the second part of the year, because the picture remains challenging. Global financial conditions are not bad. And the reason why they're not bad, we have just talked about it a few minutes ago, is because central banks remain with very accommodative policies despite what they call tightening. This is not tightening. Having real negative rates and continuing to have very aggressive levels of balance sheet, those are not certainly tightening policies. They are tightening, but not certainly hawkish, okay? So what we have in front of us is an environment in which banks, commercial banks, have found that the likelihood of having real negative rates for a prolonged period of time is very high, and that liquidity injections are going to continue. The Fed consistently increases liquidity injections via the reverse repo program. The ECB is also doing that. Therefore, what we know is going to happen in 2023 is that central banks will do anything to maintain liquidity in the system, and commercial banks know that. That's why global financial conditions are slightly stretched, but not to the point of crisis. All of it looks relatively positive. Think about this. We're talking accommodative central bank policy. On the other hand, commercial banks remain with a certain level of ample supply of credit, etc. But the zombification of the economy persists, and the rise in zombie companies is very concerning. Very concerning because in 2023, weakening margins and much worse cash flow generation are going to be not things that we look in 1, 2, 3 companies. They're likely to be the norm. So we need to think about this and be very aware of that situation. Because if we look at the market, in 2023, there is a very high risk that all of the returns that will be generated by investors will happen in the first quarter. Why? Because in the first quarter, we'll have all these sort of tailwinds that keep a certain level of positiveness in the economy. We're going to have the reopening of China. We're going to have weak commodity prices still below the levels that we would consider a very high risk. We will have the still robust messages coming from the earnings season after the downgrades, so the fake positives of the fake beats. And we're also likely to have governments talking about supporting the economy. So in that first quarter, the messages are likely to be that investors will have discounted the rise in interest rates, discounted the tightening of monetary policy, but including the reopening of China, the higher level of credit, the improvement in some conditions here and there. So that is likely to provide a certain level of optimism. The concern may happen into the second part of the year when reality kicks in. And that's what we need to be monitoring all the time. So we need to be quite short term in our view of the market. And we certainly need to be prudent, because we already saw in August what a big mistake it is to fall into the trap of believing that everything is, all the negatives are already discounted. Commodity prices are recovering from the slump that we saw between June 2022 and December. And most commodity prices are rising because of expectations of the reopening of China, the expectations of the improvement in the US economy relative to perception of a deep recession. All of this, okay, is certainly something that might add to pricing pressures. However, the most important reason why the price of commodities is going up is that the global money supply growth, that the level of liquidity in the economy is coming back very quickly. The market has realized that the world is in still real negative yield, real negative interest rates, and therefore we saw an explosion of recovery in not just asset prices, but also in liquidity provided by banks. This is an important, very important factor. What is the second factor that is affecting commodity prices? Is the very concerning levels of inventories. Very concerning levels of inventories. Zinc, aluminum, copper, US crude oil, natural gas. All of those are below the 5-year average in terms of inventory. And this obviously reduces the capacity of governments and of countries to put some brakes on inflationary pressures once commodity prices start to go up. And if China certainly takes a big leap forward in terms of credit growth, which means money printing, obviously, that is going to lead to more demand for copper. Remember that in China, a lot of loans are supported by copper. And also because of the higher level of demand for construction, in infrastructure, etc. So think about this. The monetary factor in commodities is critical. And if we go back to almost coming back to the same levels of global money supply that we had in October, this is a major factor that is likely to drive more flows into commodities in an environment of weak inventories. The Chinese economy reopening is a very important factor that may change a few of the estimates going forward for 2023. If we look, for example, at Australia, growth estimates might increase by up to 1% only because of the reopening of China. However, the reopening of China has numerous ramifications, and it's certainly a positive, but we must look at all the different aspects. First, commodity prices are starting to go up because of the largest importer of energy, the largest importer of commodities. China is coming back to growth. So that is one thing that is likely to impact inflationary pressures into 2023. The second thing that we need to take into account is that although the Chinese economy is reopening, and that is a positive, this does not offset the impact of the burst of the real estate bubble, and that is likely going to continue to generate lower growth for the Chinese economy. It's a good thing. It's a good thing that the real estate bubble is bursting. And it's important that the Chinese economy moves from a brick-heavy economy to a more added value, services, technology, etc. driven economy. However, that transition is going to cost. And it's going to cost in terms of revenues for the regions and certainly for the growth of the economy. But the reopening is certainly a positive that is likely to lead to an improvement in the estimates of GDP growth for 2023. Does that change the problem of the global economy? Not really, not really, because if we look at the problem of the global economy is the hangover of stimulus plans, is that the global economy is simply suffering the backlash of massive stimulus packages that have generated no real discernible impact, certainly no multiplier effect, and are going to lead to much higher debt, which is the flip side as well of the reopening of China. Reopening of China means global debt will likely increase yet again in 2023, and that obviously is something that needs to be monitored in an environment of higher rates.